going to be talking about the tax implications of the reform law, and we are also jointly putting together some C-suite roundtable luncheons over the next couple of months, which we'll be introducing. There'll be much more tighter discussions for your CFOs to come to a roundtable in an hour and a half to talk about the financial implications and how to plan for it. So it's a little bit more focused than what we're doing today. But with that, Teri.
And I'd like to thank Gallagher Benefit Services for giving me the opportunity to come and speak to everybody today. Good morning. So the saying goes that there's nothing certain in life but death and taxes. I think we need to amend that to include healthcare reform after hearing everything this morning. So I'm here to talk about the taxes part of that trio. And I can talk about taxes ad nauseum, but I won't because I only have a limited amount of time. So I just want to talk about a few topics today with you. The first is that there are so many new rules and the rules are continuing to evolve. There can be new federal rules that come down legislatively, there can be state rules, there's going to be administrative rules, and of course the IRS, our favorite. One of the good things is the IRS has announced that any additional guidance that they offer will have at least a 6-month window before it gets implemented. So at least you'll have time to know the rules exist, digest them, figure out how they apply to you, and that window will at least be 6 months, which may not be a lot, but it's better than tomorrow. So the first thing I'm going to talk about is reporting on the W-2s. For anybody with less than 250 employers in 2011, employees in 2011. So that means the total number of W-2s issued. You do not need to report anything at this time and indefinitely until future guidance. If you have 250 or more W-2s that were issued in 2011, then for your 2012 W-2s, you need to go ahead and include the value of the health premiums in the W-2s that will be issued in January of 2013. If you use an agent, that doesn't change your obligation. You do still need to include them. What you are including is what's called the applicable premium, and that includes both the employee and employer portions that are the health insurance premiums. And the IRS came out with a laundry list of what's included in a health insurance premium, and you'd be amazed because it's not as straightforward, and do you include dental, and do you include vision, and what about the dependent portion, and what about the portion that each different thing. They came out with a whole list, a chart that walks through exactly what it is that you need to include, which will be very helpful. That chart is included on Gallagher's website. So they'll direct you to where that is, but as long as you reference that and it then becomes just a mechanical numerical formula, you have more than 250 W-2s you're going to be issuing, you look at the chart and you figure out the dollar amount. That dollar amount does not go into taxable income for your employees, and there's been a lot of talk about that. It is not taxable income. It is for informational purposes only at this point. Maybe that changes legislatively, but not right now. When you have terminated employees, you do need to issue for them as well. And you can use any reasonable method to determine what goes in theirs, and I'll explain that in just a minute. But once you pick a method, you must use the same method for all terminated employees in that year. And if an employee requests an early W-2, because once they leave, they can say, give me my W-2 within 30 days. If they do request early, you don't have to include anything in theirs. But if you're issuing in the normal January time frame, they get included. So let's just say you have an employee who worked through April 30th of a year, and the total was $350 a month between their portion and your portion. And then they elected COBRA for another 6 months. You can either include the value of the $350 for the 4 months that they actually worked, or you can include the value for the 10 months, including their COBRA. Whichever way you do, that's the method, and then you're sticking with it for everybody. So if you have concurrent employees, meaning you have, yes?
Employees or participants pay for COBRA. Why would we be reporting the COBRA portion?
Because you're including the portion that the employee pays for as well as the employer pays for. It's both pieces, correct. So if you have related party employers and you have a common employee, you can, depending on whether there's common paymaster rules, and this is more for private business than for the government people in the room. But if you have a common paymaster, then the common paymaster is going to report all of it on the W-2 they issue. And if you do not have a common paymaster, The companies can decide amongst themselves who is going to report what and how, as long as it's a reasonable method and as long as it's consistent. If there's no W-2 requirement already in effect for whatever reason for that person because of all the other W-2 rules, then you don't have to issue a W-2 just to report the value of the health insurance premiums. And for all the S corporations and partnerships in the room, the amount that is paid for the greater than 2% partners and shareholders, that does not get reported in the W-2 box D, 12D, because that piece is already reported separately under different rules. Now, I've had a lot of people that have asked me about independent contractors, and as we've heard, the whole test and premise for this in general is 50 full-time employees or 50 full-time employee equivalents. And a lot of people want to play games with whether or not somebody is an independent contractor because then they're not going to be factored into the employee role in counting. And I highly recommend that you don't do that. There is so much enforcement action right now and the penalties are so substantial that while it seems like a great way to get out of it, I'm just going to pull people off and they're not going to be employees anymore, terrible idea. So I just want to explain why it's a terrible idea real briefly. There are increased examinations both by the IRS and by the states, and the IRS and the states talk to each other. So if you get hit with an examination by the state of Florida and they are looking for their first $8,000 of wages per employee that they get unemployment tax on, if they catch you and they're looking at your independent contractors and think some of them should be employees, they then rat you out to the IRS. And if you're under IRS exam and they ask for your list of 1099s and they decide some of them really were employees, they rat you out to the state of Florida. And that's the same in all the other states. The second reason it's terrible is they added a box on tax returns. And everybody knows whoever is signing the tax return is signing under penalties of perjury. And the box says that you are verifying that you have issued all the 1099s you're required to issue. And that may seem like an innocuous question, but if you go, well, I'm going to pay them as 1099s and then just not issue the 1099s, you're now committing tax fraud because you've said, yes, you've issued everything you're supposed to under penalties of perjury, and you haven't. That's not a good place to be. And if they reclassify somebody from an independent contractor to an employee based on all the rules and all the case law that's out there already, then you are subject to the payroll taxes, penalties, and fines for not having done all the appropriate withholding. So once again, terrible idea. Oops, okay. So there's now going to be an additional Medicare tax that is 0.9%. And this applies on wages in excess of, or at $200,000 and above. So you have your employee and you know that for the year you're expecting them to earn $225,000. That's perfectly fine. You do nothing until they hit $200,000. And at the moment that they hit $200,000, then their portion only, this does not affect the employer portion, their portion only goes up from 1.45% to 2.35% for everything above that threshold. In the original legislation, there was some talk in the rules about needing to look at household income. That does not apply at the employer level. If you have two spouses in the same family, obviously, that are working for you, you don't aggregate theirs. You're looking at each employee individually. You are looking at anything that's going to be classified as wages, which includes taxable fringe benefits, and it includes all of the non-cash items. So whether it's a car allowance, whether it's stock options that are really included in taxable income, whatever it is, the value of the property that you're giving them, all of that gets included. There is a laundry list from the IRS of what gets included in wages, and that's also on Gallagher's website. So if you are questioning whether or not something is going to be included in wages, then please double check that list. So as a quick example, let's say, yes?
Does that apply to 1099 as an independent contractor?
No, if somebody is legitimately a 1099, you are not withholding any Medicare tax on them because you're not treating them as an employee.
What about the 1099er? Do they have to?
Yes. So the other half to this is what the employer is doing on the employee, within the employee's payroll, and that gets reported on the W-2. The employee then goes and files their own personal income tax return, and at the personal level, they're only obligated to pay it to the IRS, actually owe it, if they hit $250,000 in household wages. So you're withholding starting at $200, but they don't have it until $250. So if there has been overwithholding, they will get a credit on their income tax return, just like you overwithhold federal income tax for them, and it can be used to reduce their existing tax liability, it can be used to get a refund, they can apply it to next year. So you have to do your job as the employer, and the employee gets to figure out their own taxes and whether it actually applies to them or not. Yes?
If you're moving a person from a contractor to an employee, but they still do not meet that 30 hours a week full time, does this would still apply?
If they are an employee, meaning you are issuing them a W-2, this applies. The rest of the rules, the minute they're hitting your payroll, that's the starting point for this. The employer is liable if they don't withhold the appropriate tax. So if you're supposed to withhold once you hit that 200,000 mark and you don't, you are going to be liable unless the employee does actually pay the tax on their income tax return, in which case you're only liable for the penalties for not having withheld appropriately. And wages we just talked about, it's on all cash, non-cash, anything that's considered wages per IRS rules. And one more thing I want to mention is any of the penalties or taxes or shared responsibility payments, whatever acronym we want to call them, if you're paying that, whether it's the $2,000 a person because you're opting out, whether it's the $1,000 because you didn't have the right summary of benefits plan, any of that is non-deductible. So in figuring out what the cost is going to be, $3,000 of a non-taxable payment as compared to $2,000 of non-taxable payment as compared to $3,000 of a taxable payment basically are equal if you're in a 30% tax bracket. So in figuring out everything, you have to remember that this piece is non-taxable. Anybody have any questions?
Awesome. Great job. So the big question everyone has is, okay, so what does this mean? What is it really going to look like? How as an employer am I going to